put your phone or device aside and immerse yourself in this audio story. Perfect for listening on the move, while relaxing, or for bedtime listening. We release new stories daily, so make sure to like and subscribe to not miss out. This story is based on true events. The parking lot apocalypse. In the spring of 2025, something broke in the American credit system. Not with a bang, not with headlines, not with panicked traders on television screens. It broke quietly in parking lots across the country, in repossession yards filling faster than anyone wanted to admit, in spreadsheets that banks were keeping carefully out of public view. By the time most people noticed, the damage was already catastrophic. A $150 billion crater in the subprime auto lending market that had been building in the shadows for years. This is the story of how America's most predatory lenders turned millions of cars into financial weapons, how they buried the evidence, and how the entire system came crashing down in silence while the world looked the other way. This is a dark business story about greed, deception, and the hidden collapse that cost banks and retailers millions, but cost ordinary people everything. The warning signs were there for anyone willing to look. In 2023, deep subprime auto loan delinquencies, loans to borrowers with credit scores below 550, hit 7.3%, the highest level since the 2008 financial crisis. But unlike 2008, this crisis wasn't triggering circuit breakers or emergency Fed meetings. It was happening in slow motion, buried in the footnotes of quarterly earnings reports, hidden behind the sanitized language of portfolio adjustments and strategic realignments. Behind closed doors at companies like Santander Consumer USA, Exeter Finance, and Credit Acceptance Corporation, executives were watching their empires built on predatory lending begin to crumble. They had spent 2 decades perfecting a business model that made billions by lending money to people who couldn't afford to pay it back. Now, the bill was coming due. This business thriller begins not in boardrooms, but in the vast underbelly of American commerce, the used car lots that line highways from coast to coast, where dreams of mobility meet the machinery of exploitation. These weren't luxury dealerships catering to the wealthy. These were the buy here, pay here lots, the everyone-approved operations, the places where people with broken credit and desperate circumstances went when they had no other choice. And for years, these lots had been backed by a shadow banking system that had discovered something dark and profitable. You could make more money from people who defaulted than from people who paid on time. The business model was elegantly predatory in its design. Lenders like Credit Acceptance Corporation, which originated more than $2 billion in subprime auto loans annually, had perfected an algorithm of desperation. They would finance vehicles at interest rates that often exceeded 20%, sometimes reaching 25%, or even 30% APR. A $15,000 used car could balloon into a $35,000 obligation over the life of the loan. But here's where the real financial mystery deepened. These companies weren't just hoping borrowers would pay. They were counting on them to default. Internal documents that later emerged painted a chilling picture of systematic predation. Lenders had calculated with precision that they could repossess a vehicle after extracting 18 to 24 months of payments, sell it at auction, finance it again to another desperate borrower, and repeat the cycle. Some vehicles were financed 3, 4, even 5 times, generating massive profits with each rotation through the system. The cars weren't products. They were instruments of extraction, corporate scandal machinery designed to bleed wealth from America's working poor. And for years, it worked beautifully for the lenders. By 2022, the subprime auto lending market had swelled to over $300 billion, with deep subprime loans accounting for nearly $100 billion of that total. Major banks had largely exited this market after regulatory scrutiny, but specialized lenders had rushed in to fill the void. They securitized these loans into asset-backed securities, selling them to investors hungry for yield in a low-interest rate environment. The pitch was simple. These loans might be risky individually, but diversified across thousands of borrowers, backed by physical assets that could be repossessed. The math worked. Wall Street, always eager for new sources of profit, bought in enthusiastically. Rating agencies, still haunted by their failures in the mortgage crisis, nonetheless gave investment-grade ratings to securities backed by loans to people who often couldn't afford groceries. But something was shifting beneath the surface, something the algorithms and risk models hadn't anticipated. The post-pandemic economy was creating a perfect storm of financial stress. Inflation drove used car prices to historic highs in 2021 and 2022, encouraging lenders to write ever larger loans on aging vehicles. A 2015 Chevy Malibu with 80,000 miles that might have sold for $12,000 in 2019 was suddenly being financed for $22,000. The loans were underwater from day one. But as long as the carousel kept spinning, as long as there were more desperate borrowers coming through the door, the system could sustain itself. The wealth and power concentrated at the top of this pyramid seemed unshakable. Then the music stopped. In early 2024, a troubling pattern began emerging in the data, visible only to those tracking the numbers closely. Recovery rates on repossessed vehicles were falling, not gradually, but precipitously. A car that might have sold at auction for 60% of its financed value in 2022 was suddenly fetching 40%, then 35%, then 30%. Used car prices were collapsing as pandemic-era supply constraints eased, and interest rates made new car financing more attractive. But the loans written during the bubble remained, massive obligations secured by depreciating assets. For the first time in years, the fundamental equation of subprime auto lending was breaking down. Lenders had always assumed they could recover enough from repossession to cover the remaining loan balance, or at least most of it. Now they were taking massive losses on every repossession, sometimes losing 50% or more of the outstanding balance. And defaults were accelerating. By mid-2024, 60-day delinquencies in the deep subprime market had climbed above 10%. Some lenders were seeing default rates approaching 15%, levels that made the entire business model unsustainable. But here's where this business crime story takes its darkest turn, where the real money and greed machinery reveals itself. The lenders didn't sound the alarm. They didn't warn investors, didn't adjust their models, didn't slow their lending. Instead, they accelerated. Internal emails later obtained through legal discovery would show executives at major subprime lenders discussing the deteriorating fundamentals while simultaneously pushing sales teams to originate even more loans. The logic was brutally cynical. They needed to keep the securitization pipeline flowing to maintain their credit lines with Wall Street. If loan origination slowed, the whole house of cards would collapse immediately. Better to keep writing bad loans, keep the revenue flowing, keep the stock price elevated, and hope for an economic miracle, or at least get through another quarter. This was the hidden cost of success in the subprime auto lending world. Survival required an ever-accelerating treadmill of predation. Every loan that went bad required 2 new loans to cover the losses. Every borrower who defaulted needed to be replaced by multiple new borrowers. The mathematics were inexorable, and everyone involved knew it. But acknowledging the problem meant acknowledging that the entire business model was built on sand. At Santander Consumer USA, one of the largest players in the market with over $40 billion in managed receivables, executives were watching their charge-off rates climb month after month. Charge-offs, loans written off as unrecoverable, hit 8.5% by the end of 2024, up from 5.2% just 2 years earlier. The company's stock price had fallen 35% from its peak. But management assured investors it was temporary market volatility, a short-term adjustment that would correct itself once economic conditions normalized. Behind the scenes, they were quietly tightening lending standards and reducing their dealer network. But it was far too little, far too late. Credit Acceptance Corporation, the company that had perfected the art of profiting from default, found itself trapped by its own model. For years, they had boasted about their sophisticated algorithms that could predict borrower behavior with uncanny accuracy, allowing them to price risk precisely and maximize returns. But the algorithms were trained on historical data from a fundamentally different economic environment. They couldn't account for the compounding stresses of inflation eating away at borrower income, rising insurance costs, increasing maintenance expenses on aging vehicles, and the psychological toll of pandemic-era economic trauma. The perfect prediction machine was producing perfectly wrong forecasts. By late 2024, some analysts were beginning to ask uncomfortable questions, but the mainstream financial media remained largely silent. This wasn't sexy like cryptocurrency crashes or bank failures. This was poor people losing cars, a story as old as American capitalism itself, hardly worth the attention of business journalists focused on stock market secrets and entrepreneurship success stories. But in the underbelly of the financial system, in the offices of asset-backed securities traders and credit analysts, alarm bells were starting to ring. The first major institutional investor to publicly acknowledge the crisis was Blackstone, which in November 2024 announced it was writing down the value of its subprime auto loan portfolio by $430 million. The announcement sent ripples through the market. If Blackstone, with all its resources and analytical sophistication, was taking massive losses, what did that say about the hundreds of smaller investors holding these securities? What about the pension funds and insurance companies that had bought these bonds seeking stable returns? The answer came in the first quarter of 2025, and it was catastrophic. January 2025 marked the moment when the silent crisis became impossible to ignore, when this business scandal documentary shifted from whispered warnings to screaming headlines. Exeter Finance, a major subprime auto lender owned by Blackstone, announced it was ceasing new loan originations and laying off 60% of its workforce. The company's portfolio had deteriorated so rapidly that continuing operations was no longer viable. Within days, 2 smaller competitors announced similar shutdowns. The dominoes were falling. What happened next was a textbook example of how interconnected financial systems can amplify localized problems into systemic crises. A lesson in the danger of unchecked ambition and the hidden machinery behind seemingly stable markets. The subprime auto lending market had become deeply integrated with the broader asset-backed securities market. Investors who thought they were buying diversified, low-risk bonds suddenly discovered they were holding securities that were defaulting at unprecedented rates. The collapse in recovery rates meant that even the senior tranches of these securities, the pieces that were supposed to be safest, that carried AA and AAA ratings, were experiencing losses. A AAA-rated subprime auto bond that should have been nearly risk-free was suddenly trading at 70 cents on the dollar, then 60 cents, then 50 cents. Mutual funds that held these securities were forced to mark them down, triggering redemptions from nervous investors. The redemptions forced asset sales, which pushed prices lower, creating a vicious cycle that accelerated by the week. By February 2025, the Bloomberg Subprime Auto Index had fallen 42% from its 2023 peak. Over $80 billion in market value had evaporated. But the real losses were being borne by people who would never appear in any index. The borrowers themselves, millions of Americans who had been sucked into loans they never had a realistic chance of repaying, who were now watching their cars get repossessed while still owing thousands of dollars on deficiency balances. The human cost was staggering and largely invisible to the financial press. In Dallas, a single mother working 2 jobs watched her 2017 Ford Explorer get towed from the parking lot of her apartment complex. She had paid $18,000 toward a $32,000 loan over 3 years, but still owed $21,000 due to the crushing interest rate. After the car sold at auction for $9,000, she was left with a $12,000 deficiency judgment and no transportation to get to work. Her story was replicated hundreds of thousands of times across the country. A rise and fall playing out in individual lives, each one a tragedy, collectively a catastrophe. But wait, because this is where the corporate greed and systematic deception reached its most audacious heights, where the betrayal inside boardrooms became impossible to ignore. In March 2025, SEC filings revealed a stunning pattern. Executives at major subprime lenders had been selling their stock holdings for months, long before the crisis became public. The CEO of Credit Acceptance Corporation had sold $15 million in stock between September and December 2024. The CFO of Santander Consumer USA had dumped $8 million in shares during the same period. Senior executives at Exeter Finance, AmeriCredit, and First Source had followed similar patterns. These weren't routine diversification trades. These were executives liquidating substantial portions of their holdings while simultaneously assuring investors that business fundamentals remained strong, that the uptick in defaults was temporary and manageable, that the company's risk models were robust and its balance sheet sound. The SEC filings told a different story. They knew the ship was sinking, and they were quietly boarding the lifeboats while telling everyone else to remain calm. The revelation triggered a wave of shareholder lawsuits, alleging securities fraud, but the damage was done. Trust in the entire sector had collapsed. Even healthy lenders with conservative underwriting standards found themselves unable to access capital markets. The contagion spread beyond subprime to near-prime and even prime auto lending, as investors indiscriminately fled anything connected to auto loans. Major auto retailers felt the shockwave immediately. CarMax, the nation's largest used car retailer, announced a 28% decline in quarterly earnings in April 2025. Without access to subprime financing, they had lost roughly 35% of their potential customer base overnight. People who had been able to get financed for a used car just 6 months earlier were now being turned away, not because they were less creditworthy, but because the lenders who had served them no longer existed. Carvana, the online used car retailer that had revolutionized the industry with its car vending machines and convenient delivery, was hit even harder. The company had partnered extensively with subprime lenders to expand its customer base. When those partnerships collapsed, Carvana's sales fell 40% in a single quarter. The company's stock, which had traded above $300 during the pandemic boom, fell to $8. Thousands of jobs were eliminated. The flashy vending machines that had symbolized the future of car buying sat empty, monuments to exuberance and excess. Small dealerships, particularly the buy here, pay here operations that had been most dependent on subprime lending, began failing in droves. These weren't corporate chains with deep pockets and diversified revenue streams. These were family-owned businesses that had operated for decades, that knew their customers by name, that provided a vital service in communities where public transportation was non-existent and reliable. Transportation meant the difference between employment and poverty. When their funding sources disappeared, they had no plan B. By May 2025, an estimated 3,000 small dealerships had closed permanently, unable to finance inventory or offer financing to customers. The regulatory response was swift but largely symbolic. a classic case of closing the barn door after the horses had fled. The Consumer Financial Protection Bureau announced new rules requiring subprime auto lenders to verify borrower ability to repay, a common-sense requirement that somehow hadn't been mandatory before. The SEC launched investigations into potential securities fraud at multiple lenders. State attorneys general filed suits alleging predatory lending practices. But the essential truth remained unchanged. The damage was done. The wealth had been extracted. The victims had been bled dry. The executives who sold their stock had their millions safely deposited in offshore accounts and real estate holdings. The investors who bought the securities early had already received years of payments before the collapse. The cost would be borne, as always, by those least able to afford it. The borrowers who lost their cars and their credit. The workers who lost their jobs when dealerships closed. The communities that lost access to transportation financing. By summer 2025, the full scope of the crisis was becoming clear through bankruptcy filings and regulatory reports. Total losses to lenders and investors were estimated at $150 billion. Not the flashy, headline-grabbing, trillion-dollar figure of the mortgage crisis, but devastating nonetheless. 5 major subprime lenders had failed outright. Dozens more had shuttered their subprime divisions. The market had contracted by an estimated 70% from its peak. But here's what the financial press largely missed in their coverage of defaults and losses, what this business documentary must expose. The subprime auto lending crash of 2025 wasn't an accident or an unforeseen consequence of economic headwinds. It was the inevitable result of a business model that was designed to fail, that could only function by continuously harvesting vulnerable people and leaving them worse off than when they started. Internal documents obtained through bankruptcy proceedings painted a damning picture of systematic abuse that went far beyond aggressive lending. At some dealerships, salespeople were trained to target customers showing signs of financial distress. Those arriving in older vehicles, those asking about monthly payments rather than total price, those expressing urgency about needing transportation for work. These customers were steered toward the most expensive vehicles the lender would finance, with payments structured to maximize the probability of default within 18 to 24 months. The sweet spot where the lender had extracted substantial payments but could still recover the vehicle for resale. GPS tracking devices with remote disablement capabilities were standard equipment in subprime-financed vehicles, allowing lenders to shut down cars remotely the moment a payment was late. Some borrowers reported having their cars disabled while driving on highways or while parked at their workplace, creating dangerous situations and public humiliation designed to coerce payment. The devices also tracked vehicle location continuously, creating detailed data profiles of borrower movements that were sold to data brokers, turning borrowers' privacy into yet another revenue stream. Repossession agents, working on commission and under pressure to recover vehicles quickly, engaged in practices that bordered on, and sometimes crossed into, criminal harassment. They would stake out borrowers' homes at odd hours, follow them to work, confront them in public places. Some agents were caught on camera breaking into locked garages or trespassing on private property. The violence of the system was rarely physical, but it was violence nonetheless. Economic violence, psychological violence, the slow, grinding violence of a system designed to extract maximum value from human desperation. And the billionaire secrets, the wealth accumulation at the top of this pyramid, was staggering. The CEO of Credit Acceptance Corporation, Brett Roberts, had earned over $200 million in compensation between 2015 and 2024, building his fortune on a business model that systematically impoverished its customers. He stepped down in April 2025, with a $40 million severance package, while millions of borrowers were left holding deficiency judgments that would haunt them for years. Don Foss, the founder who had pioneered the subprime auto lending model in the 1980s, had sold his stake in the company years earlier for nearly $1 billion, cashing out long before the reckoning arrived. The truly insidious genius of subprime auto lending was how it had weaponized financial exclusion. America had spent decades dismantling public transportation infrastructure, creating communities where car ownership wasn't optional, but mandatory for survival. It had allowed wage stagnation and rising costs to hollow out the middle class, creating millions of people who needed credit to maintain basic stability, but whose financial profiles made them ineligible for reasonable terms. Then it had built an entire industry around offering these desperate people loans that were designed to fail, dressed it up in the language of financial inclusion and opportunity, and extracted billions in the process. This wasn't entrepreneurship. It was systematic predation, given regulatory blessing, and wrapped in the rhetoric of free markets. As autumn 2025 arrived, the subprime auto lending market remained in ruins, a ghost of its former self. Some observers declared this a victory for responsible lending, for market discipline, for the natural correction that comes when unsustainable business models collapse under their own weight. But for the people caught in the machinery of this collapse, the experience was anything but abstract or theoretical. Maria Rodriguez, a 42-year-old home health aide from Phoenix, summed up the human cost in testimony before a congressional committee investigating the crisis. They told me I was approved, that I could afford the car, that this was my chance to rebuild my credit. I paid them $22,000 over 4 years on a $28,000 loan, and I still owed $19,000 when they took the car. Now I have a judgment against me. My credit is destroyed worse than before, and I lost my job because I can't get to my clients' homes. How is this legal? How is this allowed to happen? The question hung in the air, unanswered because the truth was too uncomfortable to speak aloud. It was legal precisely because it was profitable, and profit in America has always been the most powerful justification for harm. For those seeking business lessons from this wreckage, the moral clarity is uncomfortably sharp. First, business models built on the exploitation of vulnerability are fundamentally unstable. They may generate spectacular short-term profits, but they create systemic risks that eventually detonate. The danger of unchecked ambition is that it blinds those pursuing it to the existential threats they're creating for themselves. Second, regulatory arbitrage, finding ways to operate in the gaps between oversight regimes, works until it doesn't. Subprime auto lenders thrived in part because they fell into regulatory cracks. Not quite banks, not quite consumer finance companies, operating under a patchwork of state laws that varied wildly in their protections. When the crisis hit, this fragmented oversight meant there was no coherent regulatory response, no Federal Reserve to step in with emergency liquidity, no systematic unwinding of the damage. The companies simply failed, messily and destructively. Third, and perhaps most importantly, financial engineering cannot overcome fundamental economic reality indefinitely. You can slice and dice loans into securities. You can use algorithms to price risk with mathematical precision. You can build elaborate models that show how diversification and collateral make risky loans safe in aggregate. But if the underlying premise is that people who can't afford to pay will somehow pay anyway, your sophisticated models are just elaborate self-deception. Mathematics cannot conjure money from poverty. The psychological insights are equally stark. The executives who built and ran these companies weren't monsters or sociopaths, despite the monstrous outcomes of their actions. They were, for the most part, ordinary people who convinced themselves that they were providing a valuable service, that their customers understood the terms they were accepting. that market forces would discipline bad actors and reward good ones. They lived in the insulated world of corporate offices and industry conferences, where everyone spoke the same language of risk-adjusted returns and portfolio optimization, where the human beings being harvested existed only as data points in spreadsheets. This is how systematic harm happens in modern capitalism, not through deliberate villainy, but through willful blindness enabled by ideological commitment to market solutions and personal incentive structures that reward short-term extraction over long-term sustainability. The real tragedy is that many of these executives probably believed their own rhetoric about financial inclusion right up until the moment they were selling their stock and boarding their yachts. By late 2025, a few new lenders were beginning to emerge, claiming to have learned from the mistakes of their predecessors, promising more responsible underwriting and sustainable business models. Whether this represented genuine reform or merely a temporary pause before the cycle began, again remained an open question. History suggested the latter. America had been through subprime lending crises before, in mortgages, in student loans, in payday lending, and each time the pattern repeated itself with only minor variations. The fundamental conditions that created the crisis remained unchanged. Millions of people economically precarious enough to need credit, but risky enough to be denied it on reasonable terms, living in communities where car ownership was mandatory, but public transportation was absent, earning wages that hadn't kept pace with the rising cost of living. As long as those conditions persisted, the demand for subprime lending would persist. And as long as the demand existed, someone would find a way to profit from it. Regulations be damned. So we return to where we began, to that unsettling truth that broke quietly in the spring of 2025. Something fundamental had failed in the American credit system, and most people never noticed because the victims were invisible, the perpetrators were respectable, and the crime was perfectly legal. The subprime auto lending crash cost banks and retailers millions, but that's not the real story, not the dark secret that should keep us awake at night. The real story is that this crisis was entirely predictable, that everyone involved knew on some level how it would end, and that they did it anyway because the incentives all pointed toward acceleration rather than prudence. The real story is that we've built an economy where the most profitable business models are often those that systematically harvest the vulnerable, where financial innovation means finding new ways to extract wealth from people who have none, where success is measured in quarterly earnings rather than human welfare. The real story is that this will happen again, in some new form, targeting some new population of the desperate, using some new financial instrument we haven't invented yet, because the underlying dynamic remains intact. Those with capital-seeking returns, those without capital-seeking survival, and an ideology that treats the resulting exploitation as natural and inevitable rather than constructed and political. In the parking lots and repossession yards across America, the evidence remains. Hundreds of thousands of vehicles that were supposed to represent freedom and opportunity, but became instruments of extraction and impoverishment. Each car a crime scene, each loan a robbery, each default a small tragedy, multiplied across millions of lives, until it became a crisis that nobody with power cared enough to prevent. This is the dark side of business that rarely makes the headlines, the stock market secrets that aren't really secret at all, just uncomfortable truths we collectively agree not to examine too closely. This is what wealth and power look like when you strip away the mythology of entrepreneurship and meritocracy, the systematic conversion of human desperation into quarterly earnings, dressed up in the language of financial inclusion and market efficiency. And somewhere, in a corner office overlooking a city skyline, An executive is reviewing a pitch deck for the next innovation in consumer finance, the next way to turn poverty into profit, the next crisis waiting to happen. The presentation uses all the right buzzwords: financial technology, alternative data, machine learning, responsible innovation. The models show impressive returns. The lawyers have confirmed it's legal. The board will almost certainly approve. Because if the subprime auto lending crash of 2025 taught us anything, it's this: when the choice is between profit and people, between short-term gain and long-term harm, between wealth and morality, the outcome is depressingly predictable. The machine keeps running. The extraction continues. And the next collapse is already being built, one desperate borrower at a time, in the shadows where most people never think to look. That's the real business thriller, the one that never ends, the dark documentary of American capitalism playing out in parking lots and predatory contracts, while the world looks away. The secret isn't that it happened. The secret is that we all knew it would, and we let it happen anyway. Subscribe and listen to our next story below.